Okay, great. So good afternoon, everyone. This is Sanjeev Mota from B&K Securities. On behalf of B&K, I welcome you all to another session of our Ideation Fireside Chat. Today we have Mr. Jaideep Nandi, Managing Director of Bajaj Consumer. Mr. Nandi, who is an engineer and MBA from IIM Bangalore, has a very long stint with Asian Paints and has joined Bajaj Consumer just about, I think, more than a year ago. Sir, welcome to this Fireside Chat and thank you for giving your time.
Thanks, Sanjeev. Thank you so much. It's a pleasure.
Great. And we also have Parin Tanna, who's head of our consumer sector. So the way that we'll format this is I'll ask a few questions, more macro level and organization type of questions. And then Parin will take over asking more about the industry and what's going on. And we'll also have a Q&A box where everybody can put their questions and we'll make sure that we'll ask most of the questions as we go ahead. So that's the format.
Okay.
So I'll start with a very, very basic question. Sir, you had a great stint in Asian Paints. You have been all over the world with Asian Paints as well. And,
Yes.
Large company, market cap wise, much larger. Why did you choose to join Bajaj Consumer?
Well, I think that's an interesting question. In fact, a question which has, many people have asked in the past and I've tried to answer that. I think if you ask me, as I spent about 30 years odd in Asian Paints, I think I was also looking at how does my last part of the career look like? And while Asian Paints, that option still remained, I wanted to get something where I could make a difference to some part of whatever little part that I can work and at least put it as a part of mine. This is a pure personal this thing. And that's what in fact, we discussed with the previous MD of the organization, KVS. In fact, he also suggested some of these things. So I said, makes sense to join a listed company and take it on my own. So my interest always remained in consumer. While in the last part of my career, I did B2B handling of that Asian Paints PPG, which was a joint venture. But most of my life I have spent only in consumer. So obviously it was in consumer that I was looking for. So when we discussed this Bajaj option, when I had a long chat with Kushagra and then before that with Sumit, the sense that I got is that you have such a strong brand that you had created over the last, let's say, 15, 20 years. I mean, a brand which was aspirational, which was not an ingredient-driven brand in a hair oil industry, which is a very, very ingredient-driven category, coconut, amla, etc. I mean, this was a company which had created something of its own, and by the sheer strength of the brand, it could create the profitability profile that they had created. I mean, enough spoken on the EBITDA profile of this organization. So, but if you look at what happened in the last maybe 4 or 5 years, etc., when the story seemed to have a little bit of stagnated, it is still a very good story, but stagnated from the point that there's no further expansion or any expansion plans they've attempted. Somewhere didn't seem to have a very long-termish kind of an approach. Some good thoughts had come in, good launches, started well, 2 quarters, 3 quarters, and then suddenly there was some disturbances and that could not be seen through. So when we discussed that, tried to understand why so, etc. So I spent some 3-4 months with both Sumit and Kushagra to just trying to understand why, what, etc. Somewhere I got a feeling that while there is intent which is extremely strong, maybe in execution and maybe in planning, etc., there possibly could be some more that could be added onto it. And whatever little I've seen from Asian Paints, I joined Asian Paints when it was about 200 crores in size, and it went up by about 80 times. I'm not even going into the market cap, which is in some 1,000 times, more than 1,000 times. So that 80 times growth that happened, I could see glimpses of very similar kind of a situation that this company was going through. I mean, very, very few strong brands, and that time those brands that were there are no longer strong brands of today, like Apcolatima and Enamel or Tractor Distemper. We slowly changed the entire market behavior, etc. over a long time. I don't want to get into Asian Paints here, but I saw some glimpses of that. And I am looking at a more of a 5 to at least a 10-year kind of horizon. I mean, these are the kind of numbers we talked about. I mean, if you want to make a transformation, etc., it will, while you will look at quarter numbers and look at how you are progressing, it is more a 5 to 10 year. You should have a direction and vision what you can achieve. And this is a place where I thought that within a 5 to 10 year horizon, something concrete, something, I mean, you can really shift the momentum and make something happen. I mean, 1 2 years, yes, some results you will be able to see. I mean, a certain execution excellence, etc., you will see, but structural changing will take a little more time. And I thought this is a place where I would get that kind of a time to be able to do that. And more interactions with Mr. Bajaj, I got a sense that clearly the board and the promoter clearly had that intent and intent and vision to take it there. It's just that the execution not happening. And so one of the first things I decided, and coming from Asian Paints with so much of independence, I mean the management has and and governance, etc. I mean those are specific things I discussed with Kushagar Bajaj, saying that that kind of independence and ability to operate in that space you will have to give if I mean, this needs to be taken forward, etc. So with that assurance, I came into Bajaj, and I'll finish this statement by adding one more thing. 18 months later, I'm very, very happy that whatever little bit of apprehension I had, that whether I'll get that independence, whether the management independence will be there to be able to see through, etc. While the board will obviously have an overview of it and have their views, etc. But mostly the management and the professionals, the rest of the team, whether they can see through the vision, because not all of it will immediately bear results. Whether that bandwidth and that depth of understanding is there amongst the board and the promoter, I clearly see today, yes, that is there. And I feel very confident that they are willing to back the next 3 to 5 years plan that we have laid out. So, so this is where we are today.
Right.
Yes.
So you talked about that, the growth was quite anemic and, the focus wasn't that great. So obviously you needed to change a bit of culture of the organization, if you may, and, you've got in some people, so you have, I think your marketing head, Mr. Abhishek Prasad, he's from Pidilite. I think your Mr. Sohit Chaudhary, sales, he's from, Pepsi. You also got someone else from Asian Paints, I think on the supply chain side. So is that all that as a is that all part of change of this organization, you think? And how is your management team in place now? How is it now?
So one of the things that we wanted to do is make minimal disruptions to the overall management team and just change some of the heads where you see the kind of strategic vision that we wanted to get into. We also required people who can think. It cannot be just one person thinking. It had to be a larger team, at least a 15-20 member who's working for the team and working in various areas. So Abhishek Prasad that you mentioned is actually a person who had joined before I had joined. So he's not been a new joinee. Neither is the R&D head who had joined just before me as somebody from L'Oreal. So was the HR head. So is the CFO who's been there for quite some time. So is the modern trade. So quite a few members of the team are already there from the earlier days. Yes, some members have changed some strategies. So we got Sohit, who's coming from Pepsi. There's some new positions were created. So we did not have a trade marketing and sales analytics wing. So we got somebody who's ex Marico, ex Abbott. We had we have got somebody who will drive our e-commerce, modern trade, as well as the international. We have given that portfolio today because all of it is a small block, and we wanted to drive that. We wanted somebody senior who can take over that, other than Sohit himself. So somebody from GCPL, long experience, 18 years in GCPL. He has joined us as that. So those are the kind of strategic changes we have done. Rajesh, who has joined from Asian Paints, I mean, I personally think Asian Paints' strength is more in supply chain IT. I mean, the back end. That is where the last 10, 15 years, that's where they have built strength. So Rajesh comes in from that. He was the number 2 guy in Asian Paints, so he has joined us. So these are the kind of people that we have joined, and now the team is more or less, I can see them working together in tandem, working for the next future portfolio pipeline, how the P&L should be worked at, what kind of line item. I mean, that the entire work on ESG, entire work on governance, entire work on culture in terms of capability building within the team, lower rung, in terms of succession planning. All that now those levers seem to be working. I mean, typically what you would expect of a good, strong company. Not, I mean, I don't draw any specific, let's say, learnings from Asian Paints as such, but more from whatever else that we talk to. I mean, being a part of, let's say, the National Committee of CII, I also interact with all the other, quite a few of the other FMCG leaders, get a good sense of what is happening at there, what levers they are pushing, how much of lever they are pushing on e-commerce, on, let's say, on ESG, on any of these other parameters. And we also learn from them, cross-learn a bit, try and put in some of these parameters. That's basically where our attempt has been. And these people will be driving these agendas. Some of these agendas need to be driven by functionally as well as a corporate, as a group itself. So that's what we have taken up for the next 2-3 years.
Sure. So you talked about governance, and one of the issues that, I think shareholders have had with the company was on dividend policies. There was a change there. I think the whole capital allocation policy has not been that clear. I think there's been a bit of shift here, there. I think there was that Worldly property that was coming in as a head office, and a reasonably good amount was going in there. So what is your thought in this? How are you looking at capital allocation going forward?
So this is something that also we had discussed before. In fact, I had joined. You asked me during joining what are the parameters that we had taken up. So this is something that, because of the market sentiments and the way market sees it. So this is something that we had also discussed as to how will capital be allocated with a kind of this thing, with a kind of profitability that we generate, the profits that we generate with the retained profit. What do we do with that? So I think when I joined, immediately after that, I mean, I saw a lot of panic. I think if you look at the history, I'm not talking of a long history. I mean, you look at the years of 18 and 19. I think, let's say, calendar years 18 and calendar year 19. I think those were a little bit of a turmoil period for this organization. So a lot of flux had happened in the organization. There were some new products launched. They were withdrawn. There were some people who were asked to go, a pretty decent number. So culturally we are impacted, morally we are impacted, and business wise also we are impacted. So while the EBITDA numbers, profitability numbers overall look very nice, but I think internally people were a little shaken. And I think that bit of shaken I could also sense as far as the board was concerned. So when that first COVID happened, and in fact that was my first board meeting somewhere in March for the Jan quarter, for the October December 19 quarter. I think, yeah, sorry, that happened in January. In January itself, my first month, I could see the little bit of panic amongst the board, the promoters, to where we are going, what is going to happen, etc. And that's where you see that entire sharp cut on the dividend that happened. So I was party to that discussion. And then the next board meeting happened about 5 months later, 4 months later, somewhere in May for the year end. And by that time, I think the COVID had its full impact. March quarter was a disaster for us, I think, and there was a bit of flux happening. This transition was happening. So that time, I think the board clamped down. After that, based on the feedback from the promoters, feedback from the investors, analysts, all of you guys, as well as me talking to the board on a regular basis, we actually eased that off. I mean, last year, the dividend policy we have come back to, and now we have actually got into the dividend policy, which I'll announce in some time, which is basically in line with what most of the other FMCG companies are doing. So more or less we are back on track as far as the dividends are concerned. As far as capital allocation is concerned, at this stage, see, 2-3 things will remain. One is our our cash, reserve, which we want to keep for some of the M&A options. We'll still want to keep it. While at this moment, if you ask me whether I am actively pushing M&A or not, the answer would be I am not actively pushing, because I want to get my house a little stronger. I will not say house in order, but I'll make it much stronger in terms of able to withstand these shocks and pressures, and able to see a future direction which is the ball started rolling, that kind of a thing. But any option that comes in as far as M&A is concerned, something that I will always keep exploring. I mean, I have explored in the last 4 months 2 such options. I don't think we went to stage 2 in any of those, but those options, if they keep coming in, we will always explore. Remembering the fact that M&A in India, especially in consumer, has not been an extremely successful money if you look from the returns point of view. But strategically, you still might want to look at some of the smaller things, so that go to market becomes a little easier. So those options will remain. I'll also keep some money for my international expansion because that is something that I want to pursue. May not be this financial year because, as I said, I want to get my house a little stronger in India. But next year, surely I would be slowly stepping out, knowing how I need to work out that data. Fortunately for me, I have a little bit of experience from a different industry in the international markets, and I see what the other FMCG footprints are putting in. So while I am pushing e-commerce in India, which by next month you will see the new range that we launch, start of the new range as far as the e-commerce is concerned coming out, and that we will scale up over time slowly. The other side is obviously the international, which I'll take up from the next year. So these two levers I'll obviously keep operating. For that, we will be keeping cash in. So this is the kind of let's say dividends that we will be settling in. What we have seen last year, I mean, that is the kind of numbers you will see us settling in, which is the most comforting kind of a number to settle.
Right. So I have 2, 3 questions from what you just said. So one was on worldly property. Is there any plan now that what you're going to do?
So worldly property, see that has been the vision of the company as well as this, as well as the kind of money you've already sunk into the property. It is now a question of just building the because all your permissions have been there. I mean, the land is anyway there. So building will have to be created. Otherwise, you will just waste the land. I mean, there's no point wasting the land. So as a this thing, I mean, you would be requiring about 150 odd crore rupees as far as the building is concerned, the overall further investment. So that will happen, but that will not happen tomorrow. I mean, as and when we feel it is necessary, we will be investing. But yes, we would like to have our own office over a period of time, our own office, and maybe the maybe the family's office, maybe 1 or 2 floors for them. So, but that will be ideally exclusively ours. And in case we do any renting out, etc., it will be absolutely arm's length transaction. Either with the group companies, most likely not with the group companies, maybe with outsiders on arm's length basis. But that is if we have extra FSI. But that is something that is our future desire.
Sure. And sir, you also talked about acquisition. So, right now, Vasmol seems to be in play, and as far as the media reports, obviously, your name is not there. So it kind of ties up with what you are saying that right now you don't want to do a big acquisition. You would rather first consolidate. Is that right?
So we looked at both the brands of Streaks and Vasmol. I mean, I mean, what value Streaks brings into the table in terms of its EBITDA margin and what kind of penetration it has, as well as Vasmol. So overall, in terms of the salons, etc. What? So we have done that. I mean, the two that I talked about, obviously, one of them was Vasmol, rightly so. But then what you said is absolutely correct. Now, as a company, I mean, we have seen models where you acquire companies which are half your size, even equal size your this thing. Now, one underlying feature of any such acquisition is that you as a company need to be inherently very strong, both your culture, your processes, your systems, because you are acquiring something and you are subsuming it. If you run two different companies with two different cultures, that's a separate thing. Many formats operate like that. That company is run exactly the way it is run. You just have supervisory control and financial control, but let it run like that, or you subsume it within yourselves and run it as a larger ecosystem. Now, neither of them, I don't think we have that capability of as of today. I don't think we have the management bandwidth which can oversee BCCL's own transition as well as look at another new ecosystem completely on its own. Subsuming is a easier option because you can this thing, but then subsuming only happens with brands completely aligned to the distribution, completely aligned to the marketing approach that you have. Only then you subsume. In our case, I don't see Vasmola Sticks, I mean, these brands coming in being subsumed in the BCCL culture because you are talking of a completely professional range, getting into that, understanding of that, etc. I mean, if you look at our history, 2013, the acquisition of and history is a great teacher that way. If you look at the way we acquired, let's say the No Marks brand, the original hypothesis was that with such a small distribution, if these guys can do so much of X amount of sale, with our kind of distribution, obviously we can scale it up much larger. So 2014 exactly went like that, right? I mean, 2014, you went it, distributed it all across the country. But that was more a primary sale. It just went in, and then 2015-16, you know what happened. And because that was not a channel, OTC pharma, I mean, that is not a channel where we were strong in. I mean, even a simple thing of the skill of giving credit. I mean, that also is a skill, needs to be learned right up to the absolutely the last person. Need to know how to manage credit. I don't think BCCL as a company had the skill to even manage credit, because if you give credit to a channel, you should be knowing where the line is to be drawn. The credit management, the discipline, credit management discipline is of a different nature. So I don't think we had that skills, and that had its own backlash in 16-17. And when you went back in 18, relaunched the product, 17-18, when you relaunched the product, again those inherent issues were not solved, because you are looking at a distribution channel which is more suited to that OTC pharma. That did not get resolved. We basically just went on very heavy on the marketing aspect of it. So fantastic branding. So if you look at the rebranding of Nomarks, that's a great work. But then if you look at the business model of Nomarks, then you will say, would this last for 3 years? And then you will say, maybe not. And that's where I think the problem happened. And that's where the plug got pulled somewhere in the middle of, after about 3/4 of the product launch. And when your costs were going high, and really speaking, one couldn't fathom as to what the directions. Now, you can't have a repeat of that. That's, I mean, if the product fails, or a particular launch or any other initiative fails, that's fine. But if you say that I will withdraw it in 3/4 or 4/4 because it is not working, that is completely unacceptable. You cannot have that. No strategy can be where you say, in 3/4 I have realized that it is a failure. Unless it's a real failure which is staring on your face, you should be able to figure it out even before you launch it. So I think that is where the issues, and those learnings we cannot repeat. So this kind of acquisition, this kind of launch or relaunch, where you launch it and not able to sustain it. If you do not have the money, or if you do not have the appetite, do not launch, or reduce the number of launches, calibrate it. That's fine. But if you launch it, you'll have to stick with it for the next 3 years, 4 years, so that at least you see where you are taking it. Some of them will fail, yes, but the ones that you are planning to scale up, ensure that you are able to have the money to fund it. And that money will come from your EBITDA that you are structuring. So look at your EBITDA a little more closely, understand how the EBITDA structure is, and where you can squeeze out some money for sponsoring some of these brands. I think that understanding needs to be a little stronger amongst the larger team, not only with the, let's say, the head of the company or with the CFO, but with the functional heads, the marketing head, the sales head, because they have to squeeze out maybe a percentage out from their trade scheme consumer offers. The marketing guy has to take out 0.5%, 0.75%, and maybe put that money into digital spend. So this understanding they also need to stop, and that is basically where I'm spending my time on, to get them to see the larger picture. While they do their functional work, they also understand how the numbers are moving for the organization. For a smaller organization, this is very important. For a larger organization, it doesn't matter. If you launch a brand, I mean, the finance guy will look at as to how much money that you will require, and the brand manager will be given a full-fledged this thinking, go ahead and launch, because structurally it will not impact the PNL of the organization. In our case, it will structurally impact the PNL, and hence this sensitization is required all across, not only at my level. I think there we are making progress. There I am happy the way people are getting into it.
Right.
Yeah.
So in terms, when you talk about spending and EBITDA margins and stuff, you have actually one of the highest gross margins in the business, and EBITDA margins are also pretty high. Although I guess ad expense to sales is pretty high, but in absolute terms, you're talking about like about 45 crores a quarter or something like that, right? So I'm just saying, are you planning to change that? Because if as you invest in new categories like coconut or amla and so on, is that, are you planning to change, at least start investing more from your gross margins?
So, okay. So first and foremost, I'll split this gross margin and EBITDA margin a little bit, just for our the way I look at it. Now, our gross margin is high because we are selling one single brand, and that has a great gross margin because of the equity that the brand has, right? So to me, obviously, while I look at the overall gross margin and see how the play is, because that's where you'll make the money at, I look at it more from the EBITDA and then work upwards to see if I need to get at this EBITDA, how can I split it up? Not that I have too much of cushion in any other expenses other than is advertising and sales promotion. Other than ASP, I do not have too much of cushion elsewhere. Manpower, I have rationalized it as much as I could. I will do some more rationalization, but also on the other side, I also wanted to build capability. And for building capability, it costed us some, but not really too much. So manpower wise, we are not this thing, but I'll do some more efficiency rationalization, which we have already done. I think we'll do. I think there is still scope of efficiency rationalization as manpower is concerned. Manufacturing, in fact, the other way around. I'll require to do some more investments because all this ESG, safety, all these investments. I think I want to make a much more robust organization as such. So IT and manufacturing, you will see slow investments happening. Maybe as a percentage, you will not see too much of change. So overall, you will not see too much of change, but in absolute numbers, you'll see the numbers going up. That is because I want to put in money as far as all these initiatives that I said. So the IT team, I have put them on a 5-year IT footprint that I want for the organization. I've told them that we can't make all the investments today, but entire security, entire automation, entire the way we are going, entire ability to look at, let's say now we are into van sales, have a lat long this thing so that I can track all the vans in terms of their efficiencies, squeezing out efficiency from the system, I think, and securitization. That's the job of IT. And as far as manufacturing is concerned, both in terms of securitizing my future portfolio that I want to have in terms of both safety as well as in terms of quality and in terms of efficiencies. I mean, where you produce and what you produce. So I think these two things are more or less onto that. So coming back to your gross margin, see, I mean, there are two ways we are looking at the gross margin other than ADH. So you will have some products that we would want to launch, especially the Amla, which we have, which will have a lower gross margin than, let's say, almond drop, significantly lower gross margin. Now, I can't afford to have too many other products. So I'll come to coconut separately because there has been a lot of talk on coconut, and I think I require to clarify what we have done with coconut because it's an interesting story, and I don't think I explained it. I deliberately did not explain it during the investor call because I did not want to go out openly to too many people. But I I think it is fair to explain as to what the coconut story is. So I'll come to coconut in 2 minutes. Before that, so coming back, the product profile as such, you look at Amla, which is where I want to build brands. I have been saying for quite some time that for our kind of size, I would like to build at least 3 brands or 3 brand franchises, which will go up to 100 crores, which is maybe out of 3 products and 2 businesses, e-commerce, international, and 3 products. So between the 5 product stroke businesses, I would want 3 things to become at least 100 crores, which is basically non-ADHO, non-GT. Non-ADHO, non-GT. So I become a little stronger as an organization, and then from there I'll create the base. So I see Amla as one of the products. Now I'm looking at another 3-4 products coming out in GT next year. Not next year, this year and next year. So within those 3-4, I'm taking 2 products out of that with a non-coconut. So 3, and international and e-commerce, I require 3 of these 5 to go up to this thing. So it can be, let's say, one of the businesses between e-commerce and international, Amla, and one of the 4 products that I'm taking. So and our business plan looks pretty comfortable. That striking 3 out of 5 seems to be pretty doable. It's not a utopian thought. Now, most of the products that we will launch in both GT and definitely in e-commerce, the entire range, all of them we are looking at high gross margin products because I would rather want to reinvest the money back into ASP and keep my ASP costs high to develop brands rather than just launch products which are at a low margin. So Amla is the only exception that we have launched. Everything else will be those kind of launches. So that's how we are planning it. Now coming back to coconut. So coconut has created a lot of flutter, so to say, as to why we have launched coconut. What is the sense in that? And you are absolutely right. I mean, why would anybody, I mean, in his right mind launch coconut where there is no money to be? And that's exactly the point. I have not launched coconut to as a brand itself or as a launch to make money or to actually get much of top line either. It is more a very typical regional strategy that we have adopted. basically when we did our last year, when we did our with our consultant, when we did our low market share strategy, because one of the things we want to understand is why can't we play in South? Why can't we play in Maharashtra? We are playing in the North, we are playing East, we are playing the other parts of West, but South we are completely out. Maharashtra also we are negligibly there. Now, if you have to be present in these markets, what we need to do? So original thought was how do we reposition ADHO to these customers I'm getting? But after a bit of consumer, the plus minus with the consultant, etc., we realized that just taking ADHO back to them in whichever format and package may not really work. So one of the things that is coming continuously back to us is you need to, if you want to get into distribution, even if you have a larger range later to sell or whatever attractive range or otherwise you want to sell to them, you need to get into the distribution. So coconut is a very concerted strategy for the South as well as for the West, especially Maharashtra, to get into distribution. Our objective is to get into distribution in coconut more as an entry strategy so that it at least opens up my distribution a bit. Obviously, nothing challenging any of the larger players, but at least it gives me some foothold in these markets so that I can get in some other products. Already, our initial telltale signs are showing that because we sell in the rural markets through vans, quite a bit of it. So we are saying that we are able to go to the southern markets with the van selling and also push on almond along with our coconut. But that's really not a more long-term plan. This is what is happening now. But with the range that we are planning to look at for the next 1 year or so, both in mainly in GT, both in hair oils as well as in hair care. When we are looking at another either 1 or 2 hair oils getting launched and 2 other products in the non-hair oil category. Once we get into those, maybe in the next 4 to 5 quarters, then we see that there is clearly some headway we can make in the South and Maharashtra where we have been not operating. So this is what we wanted to do. In fact, the same learning, this is more of an extension of our learning, what we learned from our last year's experiment of van sales with Amla. When we went into the markets, in the northern markets, where we, with only almond, we could not make a van route, let's say, EBITDA positive, or let's say, turnover for the van, it could not make this thing. When we launched our Amla, with the Amla and ADHO combined portfolio, you could actually sell about 8,000 rupees, let's say, per day per van, which normally would be 5,500 only with ADHO, and the van would become break even positive. It would break even and go to about double-digit EBITDA. So that model is what we are replicating in the South, and initial signs are showing that we are gaining some distribution in the South. Not large numbers, I'll have to say that, but then we don't expect large numbers. This is reality, right? So at least there is some movement. On our base in South, anything is a great progress, and that's exactly what is happening. So neither do I want to make top line or my bottom line through coconut, and coconut is not my priority as a product in terms of strategic intent. It's a tactical product, and I'll use it to enter so that I can bring in my strategy. So that's where my coconut play is.
Sure. So, sir, uh, in terms of more categories, you hinted that there'll be more categories. So, are you looking at adjacent categories, let's say like a shampoo, hair color, or skin? Because like you already have no marks, right? Which has, which is very small right now. But are you looking at those categories so that, again, are you trying to increase the addressable market that you can, or also shelf space, so to say, both ways, right?
So absolutely. So when we looked at this portfolio expansion, this is a project we have been doing for the last 5 quarters now. So when we looked at this thing, we said that there is no of this blind, feel good launches that let's go and launch and then figure out whether it works or not. Let's go through a research. Now that we have not launched product for a long time, any market doesn't also expect us to launch too many products. So let's go slow and steady, but let's go with some bit of a plan. So last year we worked with a Singapore-based consultant, and we gave them 2 premises. Because of this R&D and that we have continuously kept on bolstering, we have a good R&D setup now with a good sort of people in their team, people from ITC, people from Levers, etc. L'Oreal, I just mentioned. So good, strong set of people that we have in R&D. So good set of products they had come in the entire hair care and the personal care space. Hair care, hair oils, non-hair oil hair care, and personal care. They had a portfolio of products. And on the other side, we said that we have to see where we have rights to win. I mean, you can have products in your R&D stable. I mean, you can also buy products from the marketplace. But finally, at the end of it, what strength would you have over somebody else that you have a right to win on that? So that project was done for about 7-8 months, where we looked at the Bajaj brand, Bajaj Almond Drops as a separate brand, and Nomarks as a separate brand, and where we tried to do a mix and match of these products that we had and the brands that we had, and see which one fits in what. And we did a consumer survey across the country. I mean, north, south, east, west, everywhere. So from that, more or less a stable of products that we would want to launch the next 3 to 4 years. In fact, I'm not able to show you. I will not be able to show you, but the launch plan for the next, let's say, 12 to 16 quarters, at least tentatively, I have. For the next 8 quarters, I have formed up plans, and for the next two more years, I have a more or less a tentative plan. So there we have gone through scoping of the market, whose competition, what kind of products, etc. I mean, the way you would launch a product, right? So there we see clearly that there are 1 or 2 more hair oils, larger categories where we are still not present, where we need to be present. And I'm leaving coconut out, as I said. Coconut at this stage, we do not have the wherewithals to make a large product of it. Amla, clearly we have, coconut we do not. But there are still some more categories which we want to cover. So overall, complete hair oils player, we would clearly see there are some more categories. Hair care, adjacent hair care, I will not name the formats, but clearly we see both in e-commerce as well as in GT. E-commerce clearly much more. Also in GT, there are some spaces which we would want to exploit, both the Bajaj name as well as the Bajaj Almond Drop name, and the adjacent personal care space. Again, there mainly where the Almond Drop name can go in. Really speaking, Bajaj as a personal care brand will not bring in much value, but Almond Drops clearly can. So exactly. So within these very pure parameters, we would like to look at the GT launches. E-commerce, we have taken a separate track. E-commerce, we clearly keep the, let's say, the Wow and the Mamas, forget the valuation model and the kind of investment they make, but the kind of branding they have, kind of approach they have towards the new gen customers, that is what we take as our inspiration to get into. And that's how we have been restructuring our e-commerce team, because it's not a question of whether or not, it's a question of when we'll launch our D2C. Now, D2C is obviously when you are nowhere, thinking of D2C itself is, I mean, completely utopian, but that's what we think and we are walking backwards. So whether it is 2 years we'll get into D2C, or whether 1.5 years or whether 3 years, I cannot say, but D2C is what we'll get into. For that, we require a range of products which can clearly be identified, which we can create. And that's exactly what you will see starting slowly next month, and then in Q3, Q4, maybe we step on the gas and further that year. So e-commerce will be treated as a completely different portfolio for that particular portfolio that I'm talking about: hair care, hair oils, and personal care. So that will be going on its own steam. We have created a team, the digital marketing team, the e-commerce performance marketing. That team is already been there on it, while we look at the GT, the normal range, continuing the way we have been. So that's, you will be getting into 2-track shortly. Because in e-commerce, the other learning that we have is even Almond Drop, for example, e-commerce is not completely exploited. That's what we are learning from the new guys that have joined. I mean, so that is also a good learning and a good eye opener for us. So that is something that we are also pushing.
Right. Sir, my last question on digital, right? I guess e-commerce is just one part of the whole digital story, but digital as both a challenge and an opportunity, right? So it's also a challenge, right? It takes away some of your moats that I think the consumer industry is facing that some of the moats may be going away, like the, logistics and, the fact that reach was so easy. On the other hand, also, as you said, you can do DTC, but then so can many other people do D2C. So which is the other challenge, but also it's a great opportunity as well. So, how do you look at it overall?
Perfect. I mean, see, I mean, absolutely right. I mean, you have exactly, when I said my sentiments, exactly the way I would want to express. It is, in my language, I would like to call it a far more democratic channel. So while I have threats from these newbie companies, I also see myself I have the gumption to think that I am equal to any of the top FMCG players in this category. I am no less. I mean, whether I have the capability to be able to service it that way, etc. But at least at the beginning, I am starting at a similar level as them. We are no lesser than them. If you look at, let's say, a typical GT channel, definitely we are not equal. I mean, if you were to talk of any of the top players, top 10 FMCG players in the personal hair care and whatever space, I mean, we are not equals. We are always behind and we are doing catching up. How fast we catch up is a different question. Here, there is no catching up. I mean, now Wows and the Mamas and God alone knows how many Nikas and all of the world have proven very clearly that, I mean, I'm not getting into the financial model. I understand that that's a valuation model. So the money they spend for building their brand, etc., is of a different nature altogether. So I'm not getting into that discussion. But I am saying that they have seen that they have shown that it's a democratic channel and the world is going towards that. How fast who catches on is where this thing will lie. And obviously we'll have to do it in a little more calibrated manner because I don't have a VC supporting me and looking at just valuation. So I'll have to manage with this PNL. So I'll have to do some mix and match. But I'll also be observing exactly what everybody else is doing and also cross-learn from them. And having said that, as I said, that they will have no better advantage. The larger FMCG players will have no better advantage over us as far as getting into e-commerce is concerned. I would like to think that because we are smaller, we will be more fleet-footed and able to this thing. And let's see how it goes. But I am very buoyant on the e-commerce part. So that's why we are investing in digital. We are getting people the digital team because the way you think has to be completely different. In let's say a traditional FMCG products, even in our company. I mean, you look at packaging, you look at a 120 days of creating the mold and then getting the mold out and finally giving the package right onto the consumer. So 120 itself is like a very short period of time. Here you are talking of turning around a product in 90 days and delivering the final finished good in 90 days, and by 90 days the product is gone. So a mix of how you acquire from sources, who you can trust, how your own R&D is working. You look at outsourcers who can manufacture based on your. So this hybrid model is something that I think in the last 3-4 months we have now come to a good sense with. I mean, if you look at last year, our e-commerce to our overall business was 0.5%. Even today, it is low at 3.5 to 4%. But at least we have made some progress, and I personally think that this has a far higher potential to do, and this can only be an add-on. I mean, this will not take away anything that is happening in the. I mean, bit of influx and this thing, etc., will happen from the B2Bs of the world. There will be some influx happening into the GT, this thing. But then I mean, as I go to the market, I mean, as I was saying, I mean, I was in Delhi day before yesterday. Some of the very large players, the kind of influx that are happening from the modern trade and the e-commerce channels, the very, very large players, not hair care players, but very, very large players. I mean, the wholesalers, etc., are completely like saying that we just don't want to do business with these guys. I mean, they don't have a choice, but that's what it is. So that impact will be there. But I think we will not be worse off than anybody else as far as this.
Sure, sir. Thank you. Parin, over to you.
Thank you, sir. So, a couple of questions. So, when we look at this space, right, FMCG space, there are two ways to go through the whole cycle. First is the distribution. So, over a couple of years back, if you see, we did see a lot of turbulences in distribution because of our wholesale orientation and our rural concentration, and which after you have been quite vocal about changing it and becoming more urban centric as well. What is your focus and what have you made changes so that the vulnerability to the market conditions is reduced to a large extent?
So see, while in the short term it will have impact because I am not promoting wholesale in a big way, but I think for the long term, for the long run, if you want strength of an organization, your direct access to retail will always be what will keep you in a good state. Because moment you get into wholesale, yes, your acquisition of the business is easier. Your cost of doing business also may be a little easier. But that will only sell what sells. You will not be able to sell what you want to sell. And clearly that is understood. I mean, I don't have to explain that. I mean, that's very clearly known, seen, proven. Now, obviously, easier said than done. So for the last 4 quarters, I mean, Q3 of last year actually is when we started that experiment of Delhi and Bombay. We wanted to specifically take up Delhi and Bombay. Because Delhi, we had been losing market shares. 18 and 19, we actually lost market share in Delhi. And Delhi is our strong. And Bombay, we can still afford to lose market share. Really speaking, it doesn't hurt us. I mean, Delhi, you get really upset if you lose market share. So I think in Q3 of last year, we realized that that urban retail is something we have to focus for the next 2-3 years, because you need to go in number terms equal to the larger players. If you are able to go equal to the larger players in your future, what you are planning to launch in terms of whatever set of products that you have, this thing, if your direct access to retail increases, clearly we'll be able to make breakthroughs. So Q1 also, if you see, while urban was negative, our retail had grown by about 40%. Now, I understand that the bases are low, but still a 40% growth is not something to be scoffed at. I think so. What we did was in Q3 and Q4, we took up urban distribution. So whether there's specific schemes for them, specific initiatives for them, I mean, POS material, just pushing business at their level. So ISR schemes, the entire schemes for our own people, etc. Everything was changed so that we can push the retail more. And I think that bore fruit in that Q3, Q4. In Q1, we, which is a part of the plan initially only I had said, for this entire year, we have just expanded that to about 10 to 12 cities now across the country, which is what we are replicating the model that we did in Delhi, Bombay. And this is something that I would like to drive for the next 2-3 years. In fact, as a KPI for the organization, I have taken urban retail as one of the KPIs of this organization, so that at least everybody has their eye on how much are urban retail. So overall numbers is good, but I want that urban retail number too. So this is something that we have done. On the other side, rural, as you are aware, I mean, through the Bain initiative, which was originally proposed by Bain for UP, and we extended it across last year, and we had great advantage of that last year. This is something that we will keep continuing. The only challenge it will now happen is we need to keep rationalizing so that the efficiencies of the vans are maximized, which I still think we have not done fantastic job. There is still scope there, and that's where I'm putting the team to, so that we maximize, we draw the maximum out of the van selling initiative. So that rural penetration that has gone up last year, from last year about 5.5 million odd retail direct presence that we had, now that number is about 8.5. So most of it has come from the rural penetration. And with urban and south, I want that number to go up to about 10 lakhs, 1 million. So if we are able to hit that number of magical number of 1 million direct, I'll be very, very happy. With a 5 million, if I can push up the 43 lakh indirect that we have to about 50, and we are able to put that 8.5 that I have today to about 10 lakhs in terms of direct, I think I have achieved quite a lot, but that may not happen tomorrow. I mean, it will take a little bit of time, but that's the direction.
Sure, sir. Just to harp on that. So, sir, what would your addressable market be from 5 million? What would you consider as your addressable touch points be in the country at this point of time, where you would want to be present?
In terms of
touch points, yes, total touch points.
Touch points meaning in terms of customer base? No.
Yes, sir. Reach, basic reach. So total touch point reach right now you have is 4.5 to 5 million. Where do you think you want to be?
In 3 years' time?
Yes, sir.
In 3 years' time, see, I'm not very sure whether that number that 4.5 to 50 lakh number, I may not want to push it further. I don't think, unless you are getting into categories which are bringing in additional this thing, that 4.5 is not something that I would desperately like to take up. Maybe 4.5, 5, 5.2, 5.3, that's about it. I don't think I'm looking at number increase there. I'm more looking at the number increase of that 8.5 lakhs that I talked about. That number I would like to increase, maybe from 10 to 11 to 12. So that 45, 50, if it goes to 52, 53, I'm fine. I'm more interested in that 10, 11 going up to 12. Because as I said, I'm not going to push wholesale too much, right? So that number going up may become a little more difficult. It is that lower number, which is, or the numerator I would like to push, not so much the denominator. So that 17% or 16, 17% that I had in terms of direct to indirect, I would now do, I am now doing about 20. That number, if I can take up to 21, 22, 23, I will rather be more interested in that rather than just look at just sheer reach. I mean, I understand your point of out of that 1 crore retail outlet, how much more can we get into? I am not looking at being our size. I'm not looking at, because the cost of servicing those very, very small outlets is also a factor that I have to keep in mind. So unless I have a portfolio which creates unique distribution, unique touch points, I may not want to go much beyond. But direct,
Sure, sir.
yes, direct is, I'll continually keep monitoring.
Sure, sir. So last question from my side. So when we reduced our pledges, there was an indication given by the promoters that at a point of time they would want to increase their stake back in the company. Any visibility on that and any timeline that you think the
Well,
promoter?
this is something that is clearly on the top of his mind. I mean, in fact, we look at all the options by which that happens, whether it be buyback, whether it be it's a stake increase of stake, a direct stake increase by the promoters, etc. So this is, if you ask me, how, I mean, I personally, whatever interactions I have with the chairman, he's extremely buoyant over the business. I think he is also managing his own this thing. He is to look at all these three businesses that he has, etc. But as far as this business is concerned, he is extremely buoyant. So I would think it should be a matter of time, but finally it's his call. So he is the guy who has to answer that question. I cannot answer it in this way. But whatever sense I get, he is extremely buoyant on this business.
Sure, sir. Sanjeev, on to you.
Yes, sir. So one question that has come is on Bain. So Bain, you had Bain, I think appointed Bain about 4 years ago. What are
2 years ago.
2 years ago? What are the key learnings from Bain that you think and you can use? So just, I think you answered some bit of that, but yeah.
So see, Bain actually, the premise of Bain was a little different, and there are a lot of good learnings that Bain had, and maybe some of the things that we wanted to over and above what Bain said. I think I would like to put it that way. So Bain actually looked at how ADHO can be further pushed and how ADHO levers can be further exploited to ensure that ADHO is completely exploited to the hilt. In fact, when Bain went into this thing that even single brand companies have been very, very successful. I mean, examples of Pepsi and Coke and even Baijiu in the Chinese multi company. So all these examples were given. Now, while that is true, the only thing, if ADHO on its own had to grow this thing, the only option that you had is the light hair oils market, which Sanjeev, as you may be aware, I mean, hair oils is split into these various categories of amla and I mean, this thing into amla and coconut and let's say cool, etc., right? The VACNO, the value-added hair oils, etc. Value-added coconut, as we call it in our this thing, and then light hair oils, which is under which we fall, and that market is about, if you take us, about 1200. These are the added these are the numbers with this thing, the way Nielsen takes it at the MRP value. So that market is about 1800 crores. So we are about 2/3 of that market. Now, unless that 1800 were to go up to, let's say, for 2500 or 3000, really speaking, almond drops taking share out of in a very, very traditional industry, taking share out of amla, taking share of coconut, etc., looks a little utopian, if you ask me. I mean, LHO itself, light hair oil itself, needs to grow. Now, that itself has not happened in the past, and unless you do some real discovery of some kind, that behavioral changes are not expected. So then you are dependent on what the market growth is. Really speaking, that cannot be part of the strategy. So that aspect of that LHO, I mean, almond drops itself can go beyond, and the market can grow little. Maybe was a little bit of a difficult one. But the other thing that Bain said is, let us exploit every single avenue of almond drops that is there and exploit it to the hilt. I think that was perfect on the spot. I'm absolutely correct. That may not have given the market share from 10 to 20% that was predicted, but I mean, you could have easily given us 12%, 13%, or somewhere there out of almond drops, out of a total hair oils. And I think some of those strategies we have taken up and adopted and following. So for example, this entire van strategy, while this has been adopted by everybody else, etc., and we had never followed this. Now, from I think Bain gave us that confidence in this thing that clearly this is something that we should leverage. And last year we actually leveraged it across all parts, and this is pretty well known now. So I think we got advantage of van sales. Some of the SKU assortments that we had, some of the smaller packs, 20 rupee packs, the larger packs in modern trade, etc., those were things. I mean, these are things that you could have learned from the marketplace. That's a separate point, but at least from the consultant, we got that. We implemented that. There's some rationalization. Really speaking, manpower rationalization, etc., was not something that is focused on, so we don't get into it. So 2-3 things of these we clearly picked up. The other cues that we got, Bain did not let's say crystallize it, but cues that we picked up is basically the shift towards digital. And even for a traditional brand like Almond Drops, that digital will have a play and we need to exploit that. I think that is something that we picked up. So with this, today we have so many Insta users, I mean, the influencers that we are using for our digital this thing footprint. I mean, that is something that we are doing. This is for ADHO. So a lot of learnings came out of ADHO, and ADHO itself had been a little bit of a stagnated brand. So a lot of the rejuvenation and product activation, mainly in distribution. I think we got it from, I would say, Bain helped us with that. So yes, we have taken some of these cues.
Right. So one question is, you are, I think somewhere you've said about doubling sales in 5 years. Are you being too conservative on that, given the size of the company? Also, what would be the margins, let's say 5 years down the line? What do you think is the right number?
See, whether it is being conservative or too aggressive, etc. I mean, mid-teen growth, etc., is never conservative for a company which has not been able to do so for a long time. And also, if you're not looking at inorganic growth in a big way, I mean, inorganic growth is not something that is clearly a done deal that within 5 years definitely there'll be an inorganic. I cannot say that. I mean, if I get, as I said, opportunistic target, then we will take it. But I don't think it's a given. Now, if it's not a given, and given that it's not somewhere where we have started the journey and the ball is rolling and now we are just adding products, etc., etc. These are all we are trying to create. Let's say Amla we created last year, now it has come to some shape, and now we're feeling comfortable. This thing that it started to make money as well as started to give volumes. So these kind of products need to be created. So I don't think the curve will suddenly start uh, doing this massive jumps. I mean, now it is more of execution excellence, hoping that the market will also do well, etc., as we establish this product. But maybe 3-4 quarters later, I am very confident that I'll see the momentum on its own picking up. Now it is a lot of interventions that is happening. So if you ask me whether 5 years doubling numbers, I would say it's a nice target. It's not extremely stretched. It's not extremely easy either. A lot of things that need to be right to do that. And if we are able to go there, then by the 4th year, I'll know whether we are going there or not. So whether it can go further up, etc., will be by that time very, very clear. But I think I want to keep a number so that my team also is not under too much of pressure to look at some unrealistic target to achieve. Now to achieve that, coming to the profile of this thing, and that's where I said I would like to differentiate gross margin and EBITDA. I really speaking, gross margin is not I will monitor myself. I will have product wise gross margin, but I will clearly monitor ruthlessly my EBITDA margin. Because that EBITDA margin is somewhere I would like to keep at the higher end of all the other FMCG companies. I mean, we are today far higher than the FMCG companies. That is possible because you have not spent so much money on distribution, because you have linked on wholesale. You're not spent on manufacturing IT, which I think you need to, because you can't keep squeezing that old system further. You have not spent. So a lot of investment that needs to make the company robust, I think needs to be done. We have been doing it slowly. That's why you are seeing some of this thing. But that is something that we'll keep investing on. And some of the money will obviously be required to spend on the brands that we do. So that 23% odd margin that we are talking about EBITDA should be. I mean, at this moment, I would like to say that, I mean, there was one question saying that now itself the EBITDA margin looks a little squeezed. I mean, given the kind of inflation that we have seen, inflationary pressures that we have seen both in LLP and RMO for us specifically. Yes, the inflationary pressures are temporary there. But I think if you put it in a grid and understand how much of that inflation is because of the raw materials, and hence in terms of modeling whether this is sustainable or not, I think all of us can do that maths and figure out. So I'm not really worried about at this current moment how my EBITDA margin is. I'm more looking at as I stabilize what kind of EBITDA margins I can look at, and I would think that 23% odd kind of a margin, if we are able to push all the levers, etc., and come up with a 23% margin, I'll be pretty comfortable.
Great, sir. I think that's all from our side. So I guess it's been a great talking to you. And I hope that you actually not only double but much more than double your sales over next 5 years. Last 5 years as a stock, it's been not a great performer. But under you, I think that can be is set to change hopefully, and we are very positive. And so wish you all the very best.
Thank you so much. Thanks. It was an absolute pleasure. Thanks, Sanjeev.
Thank you.
Thanks, Bain. It was an absolute pleasure to be hosted.
Absolutely fine. Thank you, sir. Thank you.
Thank you so much. Bye-bye.